All right. We're refreshed. We're ready to go.
Let's do it.
All right.
Yay!
Hey, everyone. My name is DeFi Dave. I lead growth at CAP, and we're a new stablecoin coming very soon. Welcome to this panel at the Yield Innovation Summit. Thank you for all coming. And this one is about institutional treasuries and yield, gaps, gains, and opportunities. And before we begin, let's go down the line. Everyone introduce themselves, who you are, and what you're building.
I'm Jake. I've been in the space for about 13 years. Currently, I'm a managing director and head of ecosystem at BitGo, and I also sit on our investment committee. So we face all new chains, L1s, L2s, tokens, onboard them, and serve as a partner to make sure that they are successful in their launch and successful in continued growth.
Hey everyone, my name is Chunda. I'm one of the co-founders of Nucleus. Nucleus is a structured product issuance platform and tokenization platform that works with clients such as the Looping Collective and Staking Rewards to issue products like L-Hype and Wrapped HLP, as well as things like white-labeled stablecoins for networks like Plume and others.
Hi, I'm Ryan Day. I am the CMO of Solstice Labs. We are another stablecoin launching soon, and we'll leave it at that for right now.
My name is Tim. I lead global strategy at Mantle. Most of you know us as the L2. We also have METH and Function BTC, both of which are billion-plus TVL wrappers and instruments. Our goal right now is to bring DeFi into the real world, into mainstream consciousness. So we're building a crypto neobank, and we are launching index funds.
All right. Now to begin. According to the latest Coinbase institutional report, the largest tokenization opportunities have been in the areas of RWA and private credit. Can you explain in your own words what private credit and RWAs are and how this trend has affected builders? Let's begin.
I expect most people know what RWAs are here, but it is literally real-world assets on chain. So that can be anything, including private credit. I think we've seen a large push lately around tokenized equities, just because that's the obvious first step where we can bring these things on chain and then start interfacing with them with other protocols and other opportunities to earn yield on what your traditional equities previously couldn't, and then also just being able to collateralize those. I think that's the big first push. And then there's obviously the more traditional RWA side that used to be talked about a lot, but has been a lot quieter lately. And that's similar to like what Yad at Animoca did with his $10 million Stradivarius violin, tokenized that with the intent to then fractionalize the shares and allow for music enthusiasts to be able to invest in instruments that would be played on massive stages, and then create an entirely new investable asset that previously was not accessible to anyone who didn't have $10 million to purchase a violin. But between those two, there are endless other assets that can be brought on chain, because technically you can tokenize anything. And so what we're seeing right now, due to the institutional adoption coming very rapidly and very strongly, we're seeing more and more of these fringe RWA options or more traditional RWA options coming to market, just because there's such a better rhetoric and opinion around crypto in general.
Yeah, I'll double tap a little bit on the private credit side. Private credit comes in many forms and fashions. Most publicly traded private credit vehicles are some form of derivation of corporate bonds. In crypto and the RWA scope, it actually kind of gets expanded a little bit. Private credit can mean anything from, the traditional corporate bonds that we know and love are listed, on publicly traded markets, but it can also mean things like settlement advances for cross-border remittances. It can mean anything from entertainment financing and payment advances for events. And so the kind of beautiful thing about crypto and the composability of DeFi is it's expanded the scope of how we can access private credit, where traditional markets would require kind of a shelling point of the amount of liquidity in a vehicle in order for the average layman to be able to tap into those types of structured products. Within crypto, we can have these kind of smaller cap iterations of private credit markets that kind of the layman can invest into. In terms of why, these have been kind of the centerpiece, or I think like the first step for RWAs is it's the simplest thing to understand. It's the simplest thing to kind of underwrite and facilitate and tokenize. Everyone has a mental framework of borrowing and lending. There's infinite demand for borrowing assets and from an infinite variety of different sources. And so the kind of low-hanging fruit of saying, all right, let's just kind of tokenize these agreements and bring them on-chain, in which, especially for a lot of these kind of more niche markets, there hasn't been a very easy way to bring them into the traditional markets. It's kind of what's inspired private credit being one of the first steps for a lot of these like RWA asset issuers.
To expand on that just a little bit, there's an interesting opportunity. I sat on a panel with this publicly traded fund that does reinsurance, and they are launching a tokenized version of those reinsurance contracts. So previously, there's a massive barrier to entry. I think it's like $200,000 or $250,000 to purchase these contracts. But by tokenizing it, they're bringing it down to $5,000. And then the yield on these contracts is 24 to 42%, which is pretty insane yield for traditional markets. So to access that yield previously, you had to be a really high net worth individual. But now you have the ability to access it much lower barrier to entry. And not only that, but then you have the tokenized form of it, which can then be used as collateral elsewhere.
I think that was great. Let's get into the fun stuff. What we're like talking about. That was a good base level. Unless you have anything to add.
Yeah, I do actually. So I have a pretty spicy take.
Oh, we love spicy.
We love
Let's
spice
hear
up
it.
here. Finally, let's do this.
All right, this might be a grand mark, but I think RWAs is bullshit.
Beautiful.
Spice dropped.
Everybody is trying to put private credit and all these random illiquid assets on chain. Nobody on chain wants to fucking buy this shit. Let's just be real. Nobody wants your 7 to 9% yielding Midwest illiquid REIT on chain. Nobody cares. There's $300 billion of stablecoin market cap on chain, $100 billion in DeFi. There's $100 billion locked in BTC ETFs alone. Instead, you should be targeting the TradFi guys who want more innovative crypto products that they can trade in existing channels. That's where the real opportunity is. And so, look, this is a shameless plug, but look, at Mantle, we launched an index fund purely catered to this, right? You have spot BTC, you have spot ETH, stake, Sol's coming. Ours is a blended of all three, staked with yield. So look, I think a lot of people can try and build in the RWA direction on chain, but you have to come back to first principles, which is like, who is your buyer, or why do they buy in the first place? I do, however, agree that there's probably a world where blockchain can be used in a way as a lubricant to make transactions better, faster, or whatever. And yeah, like we just announced our crypto neobank. It's got everything. All transactions are going to be set on Mantle. I don't really consider that an RWA though. And so look, we might be in the early stages, but today I would go where the money is. And if you look at where Circle stock is flying, that's where their demand is, not on chain.
I'll counter that and say, I mean, you touched on this a little bit, but RWAs from a tokenized equity standpoint, or even tokenized anything that's tradable in a public market, by being able to settle on chain, you have way more freedom. You can do it 24 hours a day. You have much more ability to own and move that asset that you otherwise wouldn't be able to do at all. So like, I think there's a lot that it unlocks, but I hear you on everything else. Like, it's not necessarily, I actually think a lot of the narrative in crypto right now is like rehypothecation of existing things, right? Even you look at all of these corporate treasuries that are being launched with all these different assets. They're all getting most of those assets, if you didn't know this, then surprise, from the foundation. So it's just moving from one place to another. It's not actually bringing in that much more growth.
Correct.
Any other responses?
No.
No?
Let's keep getting spicy though. Throw out tough questions. Let's get some zingers.
With the evolution of these yield opportunities on chain, what has been the biggest update to your mental model as a builder? And following up on that, how have you seen user deposit activity behavior evolve from it?
I'm gonna echo what you said. Like, it is the and I hate to say this, but the circle jerk of what's happening in the space right now with liquidity moving from one place to another, and we're all saying we're changing the financial future of everyone in the world. And like, there's no net new buyers of your next fart coin. There's no net new buyers of the next L1 chain. And so you need to find, like what you were saying, is where the money is actually going to come in. And I see a lot of these like APY and APR numbers that are thrown around. I heard just on the chat earlier, granted, it's really cool. I'm going to check it out later because I'm a degenerate, but like 200 on Kitty Swap with Hype LP, right? Like, you mention that to anyone in a boardroom that's wearing a suit and tie, and they will laugh you out of the room. They will not want to dig into what that percentage is. They won't even give it a second thought, right? And so you have to find products, or you have to find services that are going to speak not only their language, but come in at like something that they can understand. And I think Real World Assets does do a good job, and you were mentioning this, about setting a framework that they are very familiar with. They are familiar with using yield. They are familiar with insurance. They are familiar with these things. They are not familiar with hype looping, stablecoin yields, with LP track. Like it does not happen that way, as much as we would like to think so. And so I think as being in the space for a while now, thinking through my mental model is I was the biggest believer ever, but over the past couple of years, it's really taken a turn of, okay, we really need to bring in the capital first in very, very predictable products that this institutional investor is going to look at and be like, you know what, 3% extra on my yield is worth the risk of crypto. Like that is like they don't care about anything else, right? Like going from USD to USDC to them is a risk. And so how do you explain that to them? You explain that to them by giving them very, very familiar products that give them just enough of an additional yield that they're willing to start to figure out how to underwrite things and look through this in a more critical lens. But if you throw out 200% in a boardroom, they're not even going to take a second chance.
You touched on something there that I often talk about, and that is the UX and product problem in crypto. So if you can find a way to just abstract away all this bullshit that you were just talking about, and you have one-click yield opportunities, and you do it through somewhere like BitGo, where all of your assets are insured, held in qualified cold custody. You click a button, maybe click a risk profile, and then you just start earning yield, and then everything else happens in the back end. Like that is how I've changed my framing and thinking. I mean, I've been waiting for this for a long time. I've built a lot of companies in the space, but I think we're finally starting to get to that point where this is something that is coming to fruition. The product's actually getting good enough, and the participants are actually caring enough.
So agree. Opposite side of the same coin. I want to talk about the retail side because I think we can all align on everybody needs net new capital and users into the space. Similar, how do you make a one-click experience for users? For us, we looked at the space, right? If you believe, tech gets adopted on S-curves, we're probably in the middle of that. The first 15-20% came in through brokerage, trading, degens, et cetera, like you and me. The next 50-60%, they're not going to come in through a Coinbase. They don't want to see, do you want a BTC USD, BTC Euro pair? Like no one knows what that is, right? They needed something really simple, convenient, and familiar. And that answer is a bank or checking account experience. And so again, shameless plug, but we are launching a crypto neobank just because of that. It looks like Revolut on the front end, all the DeFi yield, et cetera, abstracted away on the back end, compounds on your deposit. Now, the key difference is whereas everyone else has a DeFi wallet, meaning they have a stable coin, they have a self-custodial wallet plus a globally accepted MasterCard, that only allows for one-way off-ramping, right? For us in the US, fine, you still have to go through Coinbase or Kraken or whatever your favorite exchanges to then move into a wallet. There's like 2 or 3 steps. But if you're outside the US, you're always at the risk of getting debanked, and it's a very perilous journey. With us, a user, and this works for non-OFAC sanctioned plus Americans, obviously. So unfortunately, I can't even get on this product. But in 5 minutes, you can open up a Swiss bank account, FINMA license, and a globally accepted debit card. So there's a world where in the future, you get paid your monthly salary into this account where your fiat is sitting next to your crypto in the same account, earning the crypto level yields. And you can spin it all seamlessly without even being none the wiser on where this settles or any of that.
Yeah, and you're hitting the nail right on the head where you're talking about from building the specific B2C pipeline. And a lot of other kind of companies in DeFi are kind of coming onto this realization, us included, right? This is like our entire focus of building a B2B enterprise pipeline that meets users where they are. You have to go talk to who already owns the user distribution, who is familiar with financial products and how they operate in the modern day, your Robinhoods, your Cash Apps, so on and so forth. And you have to explain to them why building this is not only going to create a net new difference for you, but also a net new difference for your business, right? And it's kind of interesting. When you look at kind of the inflection point for a lot of the larger institutions and incumbents looking at crypto and saying like, oh, wait, like, why is this so interesting? A lot of that actually came from the Q4 earnings report from Robinhood, where they saw how much earnings they were generating from crypto flows, and they were like, wait a second, I need exposure to this, because if not, they're going to end up eating my lunch, right? A lot of the older incumbents. And so you're in this position where there's this perfect inflection point of a huge wave of institutional demand and enterprise demand to integrate these modern solutions because they understand that there's a bottom line somewhere to be reached, and then there's a way to kind of change, like you were mentioning before, really materially change the lives and the experience of the net end users. It's just about building for the short tail instead of, I think commonly a lot of times builders in crypto focus on kind of reaching the long tail first and then kind of building up. I think really right now is the right time to build for the short tail, build the common sense solutions. Why isn't there a simple like gold earn product in crypto? I couldn't find one if I wanted to, right? And you go and sell that to the enterprise clients who already own the consumer distribution. And that's really like where the butter is in the market.
Speaking of Robinhood, recently they've made a massive tokenization push in their language, in their policy language, and even JP Morgan just registered an acronym for JPMD. It's pretty clear that these giants are about to enter the on-chain world and bringing their distribution channels with them. How do chains and protocols compete against this? Do they even?
It's a good question. I think so. A lot of them are going to be doing this. Robinhood maybe differently, but a lot of the banks, what they're going to do is just launch a stablecoin, and they're going to try and do what USDC and USDT are doing, right? If you look at what the revenue, I was looking this up last night. I think the revenue per employee of USDT is like $83 million, and JP Morgan is like $450,000 per employee, right? Everyone is looking. Every big bank is looking at that number and trying to figure out how do I get there. And so we are all going to celebrate when JP Morgan coin is launched on XYZ chain, and it's going to be amazing. But at the end of the day, all that money is going to be into this JP Morgan or big bank stablecoin, and they're just going to keep all the yield, and none of us are actually going to win other than the fact that we get this institutionalized crypto, and institutions are coming, and they're going to start putting money on chain for us, and all of our bags are going to get bought, and we're all going to ride this off into the moon. It's going to be amazing, right? It's not going to happen that way. We're going to get fleeced pretty hard. So what I think is important is to look for products or people who are building in the space that are thinking about how do we bring the institutions in, but how do we also give a safe space to the institutions to do what they want to do, but then also give yield back to the people who are already here, but then as the institutions get their piece too. So, shameless plug here. I feel like we're allowed to do it now. That's what Solstice Labs is doing. We're doing a yield vault with our stablecoin. We currently have a Sharpe ratio of 6.3. We've had a 19.3% average for the past 12 months on our stablecoin, right? And so when you think about the types of numbers that you would talk to a traditional investor that's coming into the space that's going to allocate a significant amount of capital, 19% is big enough that they're going to look into your stuff, not too because it's going to scare them away, and then you can start to have the real meaningful conversations about what that means. So I'll stop there and my shameless show, and we can talk about other stuff.
Yeah, I mean, this is always going to happen. From the time Tether launched with Bitfinex and you started having USDT pairs, it was clear that eventually all exchanges, all financial institutions will have their own stablecoin because it's the logical thing to do. If you use a competitor's stablecoin on your own product, then you're helping boost up your competitor. So this is just the expected thing. Now, the fact that it's coming from JP Morgan is obviously bigger news, but it's not about competing with JP Morgan's stablecoin. It's about partnering so JP Morgan's stablecoin can be used deeply all over the space and in mature products as well.
Yeah, I very much think it depends on kind of where you are in the stack, right? There's kind of different levels to kind of where people can sit, right? There's distribution at the top level. There's orchestration, like how do I gain access to DeFi yields, or the solutions connecting me to DeFi yields is like what we focus on, Nucleus, right? And then you get to DeFi primitives, and then the base level asset issuers. And so really a lot of these institutions are coming in at the base level and focusing on this asset issuer kind of competitive landscape. But if you look up the stack, there's so much more disruption that can be enabled, and so much of the pie that can be reallocated to newer entrants in the market. When an institution looks towards building a lending or working on integrating a lending venue, they're not thinking about building one of their own. You haven't really heard anyone announce, hey, we're building the next lending protocol, because they know they're not going to be able to do it, and not be able to do it at the scale that an Aave, a Morpho, or an Euler can. And so there's so much of the pie left to really be grabbed from people helping, like you mentioned, enable these institutions to come on chain and help proliferate those kind of network effects that they want to generate, whether it's at the primitive level with building products, the UX level, or even in building consumer distribution.
Speaking of pies,
Nice
Good
segue.
joke, good joke. All right, but all
Crazy
right,
segue.
let's go.
I think people are worried about JPMD and whatever all these institutions coming in because, in part, they always require KYC AML for you to play in a permissioned way, right? And people don't like it because today that percentage of overall capital in the space is very small. But what if this allows the next $1 trillion of assets and all of that is permissioned? You have the KYC AML playing that sandbox. You can be sure all the builders and everyone will change their tune and start building in that direction. So I think it's just a matter of time.
Yeah, I think as we think about the types of products that we build, right, it's how do we integrate into their front end, using them as the distribution partner, like what you were saying, right? You know, they're the typical person that opens up their Capital One app to look through stuff is never going to suddenly like bridge to hype and then loop and do all of this stuff, right? But if they have a one-click button where they can drop $100 in and get 50% yield, right? You'd see a pretty big uptake of that happen pretty effectively. But it's going to take a long time for the products that we're all building to be secure enough, to be robust enough to kind of manage that level of capital at that type of speed. But I'm very excited for us to build that, so keep doing it.
Yeah. In the spirit of permissions and regulations, the Genius Act is pretty close to passing, along with other regulations and legislation in the pipeline. What do you think yield looks like in a post-Genius world? Yield opportunities, yeah.
I think it's an interesting question, specifically within the context of Genius, because the Genius Act specifically has a carve-out for yield-bearing stablecoins, in the sense where they effectively are kind of like punting the problem down the road. I think it's like 2 or 3 years or something. Where the Genius Act has a very kind of comprehensive outlining of what the standard for stablecoin should be regulated as in America. But they specifically say, oh, this yield-bearing stablecoin thing, okay, we're just going to kind of like leave this aside and kind of like watch how it goes. And I think that's kind of the perception of the legislature right now on these types of like yield-bearing assets and structured products holistically, which is we understand the first step into the market, right, stablecoins. The question about whether or not the next step is needed or how much impact it's going to make is kind of up in the air. So I think in a post-Genius world, really I think that's when, you know, the pedal, you know, needs to slam on the floor for the industry to show why bringing yield for institutions, for consumers, for everything is a phase shift, and get as heavily embedded as possible. Because those next 2 to 3 years after the Genius Act is passed is going to be the litmus test for how much people are really going to want to entrench yield-bearing products into their product suites, and it's going to kind of move the needle on how much the legislature is actually going to care about building a regulatory framework for it.
Yeah, and by our history, I love every one of you, but you are degenerate people, and there are going to be people who are going to ruin it for us. So this is a message. Please don't ruin it for us. This is a real opportunity for us to step in and do things, but I don't trust y'all as far as I can throw you, so step it up, all right?
Jake or Tim, any questions about, any comments about the Genius Act?
You guys are the ones with the stablecoin, so.
Or just like, not just Genius Act, but just like regulation
Yeah.
in general. There's like the market structure
I
bill.
mean,
and
so
the
like,
pipeline.
there's
Yeah.
been a lot of really good market tailwinds, right? So we had the SEC put out their opinion on staking, so that was like a huge win for the space. I think that was fantastic, and it really opens up a lot of opportunities. Another small shameless shill, Solstice staking. We just opened up some Solana validators in the U.S., so come check us out. But regardless, like those types of things, those are the signals that a lot of the institutions who are crypto curious, who are sitting on the sidelines, are looking for. They're looking for a little bit of, I don't know about clarity, but they're looking for some signals that things might want to change. And the people who are on the fence that are they're trying to be not the first people, but right behind the first people. Those are the signals that they're looking for. The Genius Act, I think, is another great thing. I think in the back end of all of this, right? Regardless of how you feel about him, Trump has a stablecoin. He's going to try and do his darndest to make sure that his stablecoin is taken care of. And so I think that somewhat bodes well for a stablecoin type market Who knows? He's still got to get, 800 people to agree with him, which he's done very well before. But I think that bodes well for a lot of this. And so I think a lot of the big institutional players are looking at this as, okay, maybe crypto was really cool back in 2018, 2019. All these tech players were trying to make a stable coin, but now the big banks and the big institutional players are looking at, okay, regulation is finally starting to show up. Maybe we can start chasing some of these initiatives that we've had on the back burner, waiting for this moment, because they all have teams that are sitting around waiting for the moment to strike on this. And I think we're going to start to see that a lot. I mean, you see all the announcements that have come out in just the past 3 weeks about every single person's launching a stable coin, including myself, and that kind of stuff. So.
I'm also very interested in digital asset treasuries because you're able to not circumvent the SEC, but you're able to go to market within all the rules of the SEC on how you're supposed to operate and give users exposure to a crypto asset in a familiar wrapper today, right? MicroStrategy is the number one purveyor of that. We see DFDV and UPEX on Solana, SharpLink with ETH. You're probably going to get a couple of long tail of other ones and other flavors in other markets. I think that is super exciting. And again, it just goes to show that there's intense amount of TradFi demand for this stuff, right? Again, I point back to Circle.
It just flipped. Didn't it just flip Coinbase and its thing?
Make the math work.
Yeah, it's crazy. It's crazy. By the way, for context, they pay over half of their revenue goes directly to Coinbase, and now they're worth more than Coinbase. It's crazy.
Makes sense.
Yeah. That's what crypto is, right? Crypto math.
All right, this will be my last question. What do you guys think is the single biggest misunderstood aspect of yield on chain today, especially as it relates to TradFi institutions?
I just feel like they do not do the research, so they do not know how to actually interface with these products.
No.
What do you think?
No, I'm with you. I think BitGo has been doing a very good job of this, I think, for a very long time, right? Speaking the language of the people, getting insurance in place, getting the things that I think an institution would want to have lined up in order to step into this into the frame, right? But even still, there's a lot of legal uncertainty or fines from the SEC, right? We are tiny little fish in comparison to some of these folks, and so we're a lot less scared of getting the SEC. I mean, I'm always scared of the SEC. If the SEC is listening, I swear, I'm not here for. I'm under duress. Okay, I wasn't forced to be here. So I think things like that are coming in, and I think that will be very, very helpful. But it's going to take just a lot of robust practices and services and things that have been proven, and not just by 10 million TVL, not by 100 million TVL. I think once you start getting into the $1 billion of TVL, that's when people feel like there's enough comfort, that there's enough liquidity for them to come in, and if there's any massive swings, a run on the bank doesn't go too bad, but they're all still reeling from UST and FTX, and that's their current context, right, of what they're feeling about crypto, and they're seeing this pro-regulation, but then their only most recent news since then is everything that happened with FTX, right? Those are the big things that they're thinking about. So
I think it comes back to what you were saying. You have to speak the TradFi guy's language. So case in point, a lot of folks when they think about yield, they think of Anchor and Luna, right? They don't think about perps and Ethereum, right? When I have to explain how our funding rates and how that works, they don't understand it. But hey, MicroStrategy created this thing called Strike and Strife. It's the same shit, right? All of a sudden they understand it because you start calling it a convertible bond with different maturity and it's over collateralized. You have to translate to their understanding. And that's why I think the biggest opportunity is if you can sell it to these guys. There's trillions of capital waiting on the sidelines to be deployed here.
And what's so important there is that you actually have to convince the asset managers, the financial advisors, the bankers, because they're not going to start selling to their client until they fully understand it and they fully understand how they're going to get paid.
Yeah, that's the most important part. How do they get their fee? They're not going to put their clients' money on the line and they're not getting paid.
Right.
That's never going to happen.
But as soon as you show them that this is a higher margin business for them, then all of a sudden they're making phone calls all day long.
100%. I think everything that everyone says really kind of consolidates into one kind of core focus. Oh, I know. I got a little
Echo.
More on stage.
It consolidates into kind of one message, which is this idea of we need transparency and standardization of reporting in a way that is palatable to our end consumer, whether it be institutions or consumer platforms or et cetera. A lot of people play very fast and loose on chain when it comes to things like reporting yields, reporting how yields are structured, reporting around how exactly they're sourcing yields. And realistically, right, we're all going to have to get a lot more kind of tight and neat about, one, how all that visibility looks, and two, how we're communicating that in a standardized way. Whether that comes from top down or bottom up from the industry level, I think is something that's still up in contention. But I think really that's one of the biggest things to make sure we get that translation right.
I mean, all of this is so silly, right? Like any of this institutional adoption, any of the reporting, like we are working in a space that was built exactly for that, for transparency and reporting, for an open market. Now we're taking open market assets and moving them into a closed market in hopes of adoption. Like, kind of feels in a lot of ways like we are going backwards, but I think it's just a phase that we move through, we get more widespread adoption, and then that next phase, people are much more comfortable with the asset class, with blockchain technology, and then we can start instituting products outside of traditional markets.
Yeah, I think it's really exciting because, like, I saw that they're putting together a committee. This is on the political side where they're looking at a lot of the legacy infrastructure and reporting and all that kind of stuff comes in because you have to manage this, like, this third party, right? You have to do this third party. And what does blockchain do? It completely removes the third party. So, like, how are you supposed to legislate or work on or report on this third party when everything is kind of done peer-to-peer, right? And so it's really exciting that they're starting to look at this. Okay, what does it look like to protect investors when you have just a peer-to-peer market that's fully decentralized? And so I think a lot of, like, I was reading Arthur Hayes' piece on stablecoins, and he was saying just to open up a bank or some financial institution in Japan, you need to hire 60 employees that's just for reporting. And it's like 4.5 million a year in overhead just for reporting that you need to have in place before you even open your company, right? And so that is like non-starter for a lot of times. So that's put a little raises here in crypto, but that type of stuff I think will be happening, and so you'll start to see the need for reporting and coverage to come down as these types of legislation comes in place, which is exciting.
All right, guys. Thank you so much.
Hey, thank you guys.
Thank you.